Good morning, everyone, and welcome to our DAT Weekly Market Update. This is our update for October 17th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. We have a very special guest, hot off the heels of DATCon. We have Samantha Jones, who is the owner of Samantha Jones Consulting, and distinguished industry veteran. Good morning, Samantha.
Good morning, guys. How are you?
Good morning.
We're doing great. I thought you should know that in over 200 episodes and counting of this program, this is the first time we've ever mixed up the actual run of show, because I know you have a commitment after this. So we're going to be doing things a little bit different today. But
I appreciate the accommodation. I feel very special today.
We do what we can. Hey, you want to give folks a quick introduction? I think most people listening from your online presence probably know who you are and what you're up to. But just in case they don't, do you want to give a quick intro?
Sure. Yeah, my name is Samantha Jones. I've been in the industry for just over 5 years. Almost all of that time has been focused on shipper-facing relationships for brokerages or carriers. And in the last 3 to 6 months, I started leaning more into consulting work. And so I'm now the owner of Samantha Jones Consulting. And I focus on helping brokers and carriers as well with their shipper direct relationships or their growth strategies, and a heavy emphasis on what I call sustainable revenue growth.
And we usually save this for the end, but I want to make sure that when you pop out, folks still have a way to get a hold of you. How can they get a hold of you if they want to chat or come on your show or obviously enlist your services as a consultant?
Yeah, well, I'm on LinkedIn, so shoot me a message there. It's an easy way to connect. But I also have an email, samantha@connectsjc.com would be great too.
Awesome. All right, we can plug that again at the end of the show. So as I mentioned, we're going to mix things up. We'll talk Ohio State football outlook towards the end here in reverse. But right now, we're going to get to our question of the week because hot off the heels of DATCon, which was last week, Dean and I can cover a little bit of that towards the end. This was probably the number one I would say fraud, big topic, digitization and AI, a big topic. But then this one, as far as it pertains to industry topics, was the biggest topic, which was it's RFP season. What are some of the trends you're seeing this year? And Samantha attended both the broker and shipper sessions. So I thought this would be a good question to discuss with her. So what do you think?
Yeah, well, first of all, I remember saying during COVID that we had this unprecedented shift to the quarterly or even 6-month RFPs or monthly RFPs, where you were just in such a unprecedented rate environment that people were scared to lock in those longer term commitments. I was honestly kind of hopeful that that would drag out a little longer than it did, but pretty much as soon as we got some semblance of normalization coming back into the market, a lot of our 12-month RFP players switched back to that 12-month RFP cycle. And so we saw a lot of those go back into place in 2022. I remember when that happened in 2022, everyone was like, oh no, something's going to happen in the market in 2022 to make this difficult for people to hold those rates and into 2023. And that didn't happen. So, I mean, 2023 thus far has been pretty easy for anyone who locked in those rates in the end of 2022 for those 12-month cycles. And maybe we're starting to feel a little bit of type of a different environment right now, but nothing that's putting pressure on rates. And so brokers who made commitments have held them, carriers who made commitments have held them, and it's been pretty uneventful. So now I think everybody's worried. And that's why we're talking so much about 2024 as we come into this RFP season, because what we thought was going to happen hasn't happened yet. So it's like we kicked that can farther down the road and everyone's now expecting something to change at some point within 2024. But even as we were all prepping for that, you start to hear economists with these little murmurs of 2025, right? Like maybe nothing's going to change significantly until we get into the end of 24, into 25. So now I think we just have a lot of people trying to determine how to balance risk for where we're going to price things right now in a very, very low rate market environment currently in the spot space, especially. So it's going to be a different balancing act for brokers versus carriers when they're going into this RFP. But then when do we expect to see that meaningful shift? I think was a question that I heard repeatedly at DATCon, right? When are things going to change? And how many months of the year will that leave us exposed if things change based on what we priced into a 12-month RFP? So I think that that's hot on a lot of people's mind right now if we're considering 12-month RFPs. I think the good news for anyone running a 6-month right now is that we might feel fairly confident we know where the market's going to be for the next 6 months, barring any unforeseen events, which is always a risk that we take. So that's kind of my initial thoughts there on the 12-month versus the 6-month, and people feeling a lot more uneasy, I think, this year about that 12-month RFP cycle.
Yeah, I was kind of amazed, to be quite honest with you. Two things I heard: we had what 75 Dean shippers or so in attendance,
Correct.
Almost to a person. And I'm not saying I talked to all 75 of them, but everyone I did talk to said that the signals they have in the market now, the ones that are running RFPs now, are seeing for the first time in 18 months some pressure,
Right.
which I thought was interesting.
Mm.
And I think secondarily, this concept that they're kind of crafty, right? So shippers that are running RFPs are kind of crafty, right? This sense of they can hide their risk, I think, next year, in the sense that inflation's still probably going to run at 3 to 5 or 6%, let's just say, on the low side next year. You can, if you go out there and you give your incumbents 5% basically increase. I know it doesn't actually manifest as an increase, but let's just say the net result of the bid is a 3 to 5% increase. You can go to your boss and say, look, I'm trending right at inflation. Or if you go in that 3 to 4%, I'm actually underperforming inflation. So I'm actually saving us money, right? Because the revenue side is inflating, especially the CPG companies. The revenue side is inflating along with CPI. So it's an interesting strategy where I think shippers for the first time in a long time have some air cover heading into a year of uncertainty. But it was really interesting because you kind of just don't get that reading from the trade press, right? You kind of have to go talk to folks. And that was really an interesting tidbit I picked up last week.
And I think from the shipper's standpoint, I mean, that's going to be a tricky one based on who you're allowing in your portfolio and who are you awarding. Are you awarding your large asset carriers? Are you awarding brokers? Are you awarding those mid-sized carriers? Because everyone's going to have a different feel and a little bit different exposure to the market as well over the next 6 to 12 months. So I think the trickiest part for me, if I'm a shipper, is trying to balance who am I awarding? What's my mix of asset broker or larger asset fleets versus smaller asset fleets? And how might that impact them throughout the next 6 or 12 months? And what would that mean for me as far as my rates holding? I know a lot of brokerages, I've seen evidence through shipper partners of a lot of brokerages pricing market even, and they're making all of their margins in fuel surcharges right now. Well, that's, and as we're seeing the instability in fuel, especially lately, if that means sustained fuel rates throughout 2024, then that will continue to work. That tactic now works, right? But that doesn't work as well for maybe like the smaller carriers or the large carriers we know who buy fuel lower than that anyway, who are taking that fuel surcharge. Again, they're allowed to be more competitive. So there's nuance as well to who you're partnering with and what their procurement strategies are, I think, and what their pricing strategies are, quite frankly. And so if I was a shipper, I think you've had ample time and fairly lax markets right now to be digging into understanding your supplier base better and understanding what their sourcing strategy is, maybe trying to get a read on what their pricing strategy is and what their commitments to you are. And then also, I think something else I would be considering right now is that there is ample capacity within fleets. And the last time we did, if let's say we do see a market flip in 2024, somewhere in, I don't even know, Q3, what happens to the capacity that you have committed to you? Do you have that capacity committed to you? Because I think right now, if carriers are bidding on lanes and they're taking an award, what happens if we see a 10% increase in tenders tendered over to those carriers in the later half of the year? Are rejections going to increase, or are they going to continue to hold at 98%, 96%? I don't know about that, right? I think we're going to see that start to slide down to that 90%. So I'm advising, shippers in conversations, what would it mean for your business if your tender rejections today went from 98% acceptance to 90% acceptance? What happens to that 8%? Where does that go? If it goes to spot right now, probably not a big deal. If that goes to spot in 9 months, that might be a big deal to your budget. So trying to understand how much of the carrier capacity you have is really going to be there for you when you need it, when other people are starting to reject tenders. I think, again, it's just a lot of conversations on the front end on this RFP season to make sure that you understand who's committing how much capacity to you for the year and what that's going to look like.
Samantha, on that point,
Go ahead.
Well, on that point about first tender rejections on incumbent carriers, one of the trends we've noticed, and Professor Kaplis and Chad Kennedy spoke to it at the shipper event last week at DATCon, was more strategic buys on the spot market vis-a-vis not including all of the low volume lanes in the tenders. And they showed a chart that I thought was fascinating that looked at the spread and the lane density across the spend and the volume, and it showed that 15% of the lanes in our shipper world account for 75% of the spend and 80% of the volume. And the flip side is that the 20% of the volume that happens on 85% of the lanes were not going into RFPs in the main and going direct to spot market. So that impacts the rejection rate, because the rejection rate will tend higher because there's fewer first tender rejections, because those lanes that are prone to failure because of low volumes primarily won't be in the routing guide in the first place. Are you seeing anything like that on the ground?
Yes. So on the tender rejection side, let's say, and this is kind of goes back to Ken's comment about shippers can be pretty crafty sometimes, because it's the same in an RFP. I was a part of a brokerage. We would bid lanes in an RFP that were one pick, one drop, 250 miles. Who knows what you bid that at? Some people bid that as low as 400 or, $500. And then it gets tendered over with 3 stops in between with a $50 stop off charge. That, like, there is ugly freight out there, right? And then they hide it in plain sight, and then it's sent over, and it's like, what are we doing here, guys? So there's a lot of nuance to what looks appealing in an RFP versus what's not appealing once it comes to you after an RFP.
Right.
Or same with asset carriers who, asset carriers might bid low volume lanes. They might bid 50 of them coming out of one origin point, thinking as long as I have enough volume here, I'll be able to have a truck that's moving something constantly. Maybe they get awarded 5 of them and they validate and take that, so then you don't have your equipment where you need it. There's a lot of nuance that pushes to tender rejections. I think in general, rejecting a tender the last 18 months was like a cardinal sin. I mean, like, you didn't want to risk being put in a spotlight of like, oh, they're our only person that's rejecting tenders right now, and risk any type of an award when, quite frankly, everyone was asking for more volume, not less,
Right.
no matter how undesirable the lane may have looked.
Right.
And so you didn't want to put yourself in that spotlight. That's what I'm seeing now. I think we're seeing some progress. Some outlets are saying that we're moving down to 96% from 98% acceptance already. I think as there's a little bit of stress and tension on rates in certain markets now, you're starting to see brokers and carriers try to start saying, okay, can we reject that 2 to 4% if it's really something that's hurting us, or if it's really cutting into our profitability? The other part of that is when rates were so low for so long, especially for brokers, they were able to make good money. As people start to experience margin compression as the result from mini bids, 6-month bids, things that went into place in 2022 and 2023 that are lower margin rates now, they don't have as much wiggle room to play with it. And they're not willing to take a $200, $300, $400, $500 loss or more if something comes over that, quite frankly, they're going to lose money on. So they're starting to figure out what's hurting us right now, and can we shed that, or at least make sure we're balancing that 90%. And so you're going to start seeing people move more towards that 90% number instead of those 96, 98s as things get a little tighter for them in the market. And I do think that comes back into play.
Got it.
Yeah, I think you're right. I mean, coming off record, I mean, Dean's been beating this drum for a year and a half now. Coming off a couple record years, putting some money in the bank. If you're a fleet of any substantial size, you're able to weather a little bit more, and maybe even in this environment, it's still possible. I mean, I'm sure Chris Jolly. I just love his approach to any market, right? Which is like, you can make money in any market, up, down, flat, in between, right? In the sense that there's still carriers out there taking share right now. Certainly there are, right? There's been 26,000 motor carrier numbers that evaporated in the last year, net. So there's shares going somewhere, right? Which is, I think, an interesting phenomenon. We've got a couple questions trickling in. Maybe we get to those now, Dean.
Cool.
Yeah. Matt Clark asks, I've seen some articles this week on why smaller carriers haven't exited the market as quickly as expected. What are your thoughts? Samantha, you want to have a crack at that first? I've got some thoughts on that also.
Yeah, sure. I think I saw probably some of the same articles that he's probably referencing. I would say, number one, I do think that we underestimated the reserve on some of these carriers, like you guys said, from those sustained high rates the last couple of years. I also think he's going to ask specifically for small carriers, so I'll try to stay in that. But yeah, I think that's part of it, is like the reserve that they had. And then 2, we just in the last few months dipped below what they would consider the operating costs for most small fleets, but we've been on this really long, slow decline. So I think less than like this mass exodus, it's been like this really prolonged, like drug out market where it's incrementally started to build to hurt a little bit more every month, right? And so I think that the people who had any type of reserve have been kind of using that and chipping away at that and trying to last through this. But the longer that the market drags out, the harder it's going to get for some of those carriers. But I think that that's just why it's been slower, because they had a reserve to lean back on. And then it wasn't like rates just plummeted to nothing all of a sudden. It's kind of been like this, working our way down the mountain slowly and progressively. And it gets a little bit uglier every couple months.
Yeah, I think you're spot on. There's a couple of reasons why the exodus has been much slower. One was the incredibly profitable period that carriers had for the longest period of time. It really started in the middle of 2020, lasted all the way through until Ukraine was invaded by Russia. For context, Matt, to answer your question, we all remember 2018 as being a really good market for carriers. Gross profit margins averaged about 30 cents a mile. We're down to about minus 6 cents a mile today. But if you think about 2018 as being a strong market and then look at the 2021 market, we went from 30 cents a mile to about $1 per mile gross profit. And that period, that 18-month period from the middle of July to in 2020 to the end of 21, set a lot of carriers up for an ability to pay down a lot of debt and build a pretty long runway to weather $5.80 a gallon last year. And Todd Amon at ATBS said a little while ago that for the first time ever in his history, he was seeing carriers opt to sit the market out when diesel prices skyrocketed because they could afford to. So I think that's exactly what happens. A combination, I think, of diesel prices dropping about 84 cents a gallon up until July 4 this year. That helped as rates dropped. And then the backup they had. But I think that runway will run out at some point, if not already.
Yeah, I mean, Craig Fuller had a really interesting piece about kind of brokerages being a main factor for this, which really substantiates what we've been saying for the better part of a year, which is brokers winning more RFPs keeps freight in the spot market because they cover it spot largely with small carriers, right? So I think that's part of it. I think the reserves, I think generally volume hasn't been as bad as we would like to make it seem. I mean, I think if fuel wouldn't have went crazy, it would have been more of kind of like a soft landing freight market at the moment as opposed to where we are now. I will say October net motor carrier numbers are looking very, very bad. I mean, there's a chance we could lose 3,000 interstate motor carrier authorities this month, which puts us over. So Samantha, like we've talked a lot on our show. We thought, Dean and I, or maybe just me, I don't remember, but like 25,000 net attrits was probably around equilibrium. It's very inexact science, but that felt kind of right. It's looking like we're going to blow past that this month, which means even if we have a stair-step recovery back to net positives, we could end up 30,000.
Right.
Not surprising, right? It's a market that tends to get overbought and oversold. Very rarely do we just kind of conveniently touch on equilibrium and climb back out, but concerning nonetheless.
Right. And I think that you touched on it. And that's what I thought as Dean was talking as well, is like volumes aren't as bad as people maybe thought they were. Like the volumes that are there in trucking are not as disastrous as people maybe felt they were. It was just that we were coming off such high levels that were not ever going to be sustainable. I mean, I know several publicly traded companies that depending on their commodity types, they literally experienced 30% growth year over year in 20 and 21. Like that was never going to remain after the like certain habits that were picked up, if you will, during the pandemic for buying patterns. And so a lot of that was going to have to come back down to a normal trend line. And as it did, like that's what we've lost. But overall, it's not like volumes are dramatically below like pre-pandemic levels or anything like that. And so we had this record amount of carriers that a lot of people were calling, like we have so many new entrants to the market during 2020 and 2021. And so I think it's quite simple that as the volumes have come down a little bit, the carriers are just really keeping pace with volumes, right? And so if we see a little bit more carriers leave, then that could start to be a little bit of tension in the market. But again, waiting for that some type of outside event to drive the volumes higher to see a meaningful change in the market.
Yeah.
And one more question, Ken. Oh, sorry.
I was going to read Jose's question.
Okay.
Is that where you were going next, Dean?
Yep.
So do you think accepting low rates is extending the lull in rates? Well, unfortunately, that's how this whole thing works.
Yeah.
Right?
I
Apple
mean,
price goes up because more people want to buy it than want to sell it. It goes down when more people want to sell it than want to buy it. And unfortunately, there are more trucks than people that want your truck right now. Well, I mean, maybe not in aggregate,
right.
but you get my point there.
Well, it varies a little by market, right? But in general,
Yeah.
I would say yes to that. And so, I mean, I think when you think drivers accepting low rates is extending a lull in rates, I think there's some really low rates that are contracted right now to brokers. And if you look at what the brokers are selling it for in spot, and maybe you don't like that rate, I'm telling you that I know there's large brokerages out there making money on nothing but the fuel surcharge, like there's not a whole lot extra give there. I think in general there's plenty of brokerages who are operating on very uncomfortable margins for their operational styles. I think brokerages that might have been making in the 20% margin range, some of them might be running some of their accounts at 6 to 12% right now and not loving that. So I think there's a lot of stress in general on rates that was applied in the last rate cycle. And so I think I would be kind of shocked if we saw any type of significant downward movement as a whole on rates after this RFP season's over, because I just don't think anybody's feeling confident enough to continue to push the rates down farther in the current market environment. But I guess that will remain to be seen.
Yeah. I guess we'll just end on this because the question comes up is like, why in this part of the cycle do broker margins compress? And, talking about it a lot, I think when the market is declining, broker margins are typically expanding because they're riding the wave of contracts that were executed during a higher point in the market. And as the market has slid, they cover that in real time lower. And the problem is over the last 6 to 9 months, maybe not even that far, maybe 3 to 6 months, the new contract rates have entered their revenue, right? They've booked in their new contract rates, which are substantially lower, which kind of immediately, it always happens very quick. And then immediately puts a lid, as Samantha said, on margins, which is tough. It's a tough part of the cycle. This is for pretty much everyone except shippers, the toughest part of the freight cycle.
It was a hyper aggressive RFP cycle, this last cycle, because what happened, especially, I mean, again, I'm a little biased to the Fortune 1000 space because that's predominantly where my interactions have been the last few years. But a lot of these shippers ran these RFPs. A lot of them had incumbent brokers that started in 2020, 2021. They had brokers up to 40 some brokers that with awarded contracts. Every broker knew that was not going to remain the case. And they knew that some of these companies exited over 20 brokers in one RFP go around, right? So they didn't want to be one of the ones that were exited. And quite frankly, like service was part of it, but it predominantly became a rate game at that point. And so you saw brokers basically chase each other down to lowest rates. And a lot of those rates that were awarded this last go around were not ever intended to make large margins. It was more just like preservation of contracted business, right? These companies couldn't afford to lose the $5 million contract here, a $3 million contract here. And a lot of brokers had increased their contractual presence with these larger shippers. And so it was basically, in my mind, if I was one of those brokers at that time, it's like, what's worse, losing it entirely or making minimal margins to try to grow it again when the market flips? At least I'm in the door. And I think that was the choice that they made, was to go ahead and try to retain. And so you had these rates get pushed down. I've heard it from shippers. Some of them saw 15 to 20% concessions on rates the last go around. And so when you think about if you took 15 to 20% off of your rates, of course you made really good money, right? Because the spot market largely wasn't unchanged for the buying of those brokers. So really they just came down on what their margins were. From 2 months ago, that new award went live. Now they're running on lower margins and basically probably buying the same still. They might have put a little pressure down on the market, but not a whole lot. And so that's where you're seeing the margins compress in the brokerage space. I've been saying this for a while, that it's going to continue that way. And we're talking a lot about carrier attrition. And I think we need to start talking about the financial health of a lot of brokerages. And if I was a shipper, I'd be digging into that. Probably more your mid-sized guys. There's a lot of brokers in that space that aren't these mega brokerages with the deeper pockets. But what are they doing right now to handle that margin compression? And if they're not laying people off, their operating costs are staying the same. And is everything going to stay comfortable for them for the next 6 to 12 months?
All right. I want to make sure Samantha gets to her next commitment without a service failure. So we want to thank her for joining us.
Yep.
Always a pleasure. We hope to have you back on soon. Maybe we can come visit your program and grab a coffee with you in the near future. So thank you for joining us, and have a great rest of your week. So we are now going to bounce to our regularly scheduled programming.
Yeah.
I'm out of sorts now, but let's go to our key points of the week. All right, key points of the week. Give me 1 second. I'm a creature of habit. Here we go. Okay, so we've talked about a lot of this, but van and reefer spot rates lose some ground, which is no bueno this time of year. This is absolutely not what we want to be seeing as we head into Thanksgiving. If we're exhibiting a similar trend this time in November, I think that's time to really sound some like DEFCON 1 alarm bells. Dry van active contract rates did show a slight decrease. This is actually a good sign. It reads like a bad sign, but we need these rates to actually level out to zero. From a net change perspective, replacement rates decreased to low single digits after getting out of that double-digit period. The Michigan State Trucking Ton Mile Index up slightly in August, but down 2% year over year. That is above the August 18 levels. We got a quote from Jason Miller here. If interest rates remain elevated, we may be looking at a soft demand environment for at least 9 more months. And then diesel is down 6 cents a gallon to $4.44 a gallon. I think this is interesting, right? There's some stockpiling of fuel going on to prepare for a potential expansion of instability in the region. And so I think, like, I'm not a fuel expert by any means. We intended to actually have a fuel expert on here sometime soon to explain this to us, and we will try to keep working on that. But with that, I'll turn it over to Dean for our market update.
And we'll do an abbreviated market update today to keep on time. The long-form version of this week's market update will be printed this evening, dat.com/market update. It's under our resources tab and blog posts. So look for that this evening with all of the detail and charts. Having a look at the load-to-truck ratio quickly, load-to-truck ratio trending very closely to both 2018, 2019 levels. Load posts are down for the second week in a row. Carrier posts were pretty flat, though, last week, as there's a steady flow of carriers exiting from the industry. Load to truck ratio flat at 2.09. In the refrigerated category, influenced heavily by a lower amount of produce volume, particularly moving out of California. It's the largest market in the nation at the moment, soon to be taken over by the Pacific Northwest with fall produce. But right now, the 13% year-over-year decrease in produce volume out of California is putting a bit of a drag on the reefer market. Load to truck ratio also flat at 2.87, almost identical to 2019 levels. And in flatbed, load post volumes were flat last week. Volumes still about 37% lower than 2019. Load to truck ratio remained at 6.63. Looking at a couple of the markets this week, our top 5 markets produce about 25% of our load post volume. Capacity loosened in all top 5 markets, California, Georgia, Illinois, New Jersey, and Texas. Spot rates were down 3 cents a mile last week to an average of $1.72. For context, that's 5 cents a mile higher than in 2019. One of the high volume lanes I look at a lot to get a sense of how the peak shipping season is playing out is Los Angeles to Chicago. A third of the intermodal volume moves on that lane. Spot market rates for truckload averaged $1.34 a mile last week. We compete heavily with intermodal on that lane. At $1.34, that's $2 a mile lower than at the end of 2021 at the peak of imports from Asia. Quite the difference. In refrigerated, good volumes coming out of Oregon and Washington State. Rates are just under $2 a mile at $1.96. Our rate cast is forecasting another 15 to 20 cents a mile higher by the end of the year. That's pretty much in line with what we see normally over the last few seasons. One of the other high volume lanes we look at is Atlanta to Orlando. It's a very busy refrigerated spot market lane. Rates dropped 5 cents a mile last week to $1.71. That's about 50 cents a mile lower than this time last year. And then flatbed, capacity tight in Portland, seems to be tight a lot of the time up there this time of the year as we head into Christmas tree season. Rates are averaging about $2.40 a mile there. And in Dallas at $1.96 a mile, rates were up 4 cents a mile last week, while next door in Fort Worth, rates averaged $2.02, up 11 cents a mile in the last week. And having a look at our year-over-year look at spot rates, as Ken mentioned, dry van rates lost more ground last week, down 2 cents to $1.57. Compared to last year, that's 24 cents a mile lower. And as you can see from the chart, sitting just 3 cents a mile higher than 2019. And compared to our top 50 lanes, which averaged $1.88 a mile last week, That was 31 cents a mile higher than the national average of $1.57. And in refrigerated, $1.88, the reefer line haul spot market, 26 cents a mile lower than last year and sitting just 5 cents a mile higher than 2019. And in flatbed, last week's average was flat last week at $1.88, still 24 cents a mile lower than this time last year and identical to this time in 2019. So that's it for this week's market update. Remember, if you want to find out more about what's happening in freight, DAT.com market update is the place to go this evening for our long form version of the weekly report. Ken will take us through the short-term forecast now.
Hey, Dean, we're running a bit long on time. I think we can catch the short-term forecasts.
Sure.
This is pretty much indicative of what you're going to see, which is flashed on the screen right now. I think people can just get caught up on those on the long form market update. I think the too long didn't watch piece of that is that there's some model disagreement, but seasonality should start to exert itself here in the next couple of weeks as we head into peak. So again, check all of that out. I know we ran along with our guest Samantha and a ton of audience listener questions, just the way that it is sometimes. So do you have any plugs, Dean?
Yeah, a couple, Ken. Main event is on. I'll be on with Chris Kaplis on Freight Vine. That's out this Thursday, the podcast. Kyle Patterson from DAT is at TIA's Technovations Conference in San Diego this week. And our guest next week is shipping expert John McCown, talking about the latest trends in the coastal shift in imports and if that's still happening.
So the final question of the day, there hasn't been a mountain lion spotted in Pennsylvania in over 150 years. Should Penn State change its mascot? I don't know. Maybe it could be a walnut after this weekend, or maybe we lose. Who knows? All right. So we will be here next week with all of those trends in the freight market. I highly recommend you check out Samantha's podcast. She most likely just went live in the last 2 minutes with her guests. It's really good long form content. I would recommend check. You're going to be a guest right on Chris Kaplis's podcast coming up, right, Dean?
Correct. Yeah. Yep,
yeah, so that's going to be great. I wanted to thank everyone just as we wrap up here today. DATCon last week was absolutely excellent. I'm sure there'll be a recap and video coming out from our wonderful video team. But to spend a week in Houston with 400 of our closest friends and customers was absolutely stellar.
Right.
I learned a ton, had a lot of great conversations. I got to watch armadillo races for the first time in my entire life, which was something I bet the farm on Speed Bump. It was the armadillo I handicapped to be the fastest, and it turned out to be lucrative for me, but it was a really, really great event. Again, if you're listening and you were attending, I wanted to thank you for coming. And if you are listening and didn't attend, I would highly recommend planning to come next year. It was really a great event. So really awesome time. With that, we will be back next week. Thanks for hanging with us a little long today. We hope you have a great week and we will see you later. Bye, everyone.
Bye.